These 5 things will instantly make you a better forex trader. What is going on, everybody? So welcome back to today's video. In this video, I'm going to be going through 5 things that will instantly improve your forex trading. These 5 things have personally helped me to become more consistent and make more profits in the market. So I hope this video will bring you guys a lot of value. And if it does, make sure to like and subscribe for more content like this. And let's get straight into the processes. Alright guys, so here we are, 5 processes to improve as a trader. And at the bottom I've also said that these will instantly improve your performance, and this is because these are not things that, you know, are going to take years and years to improve upon. They're stuff that you can, or things that you can start to do right now in order to improve. Obviously these are going to take time. Once you start implementing these, there's going to be a lag between implementing them and seeing the results that you want. But as soon as you start to implement these, you will start to consistently improve as a trader, and eventually you will obviously reach your desired goal if you consistently start to do these 5 things. So step 1 is to actually just write out your trading plan. I know a lot of people watching this and most traders actually don't have a written trading plan. And having a written trading plan is really essential to be able to consistently withdraw money from the markets and to consistently perform at a high level. You've got to think about this in terms of from a business perspective. Every single business once had a business plan. They didn't just randomly go about their business doing this, doing that, and doing all of these random things. Everything is calculated. Everything, you know, there's always a thought process behind it that's written out beforehand. So what we want to do is have a clear set of rules to follow and execute these whenever the trade appears. In my opinion, it's best if this rule set is as simple and as mechanical as possible to make it repeatable, and this basically avoids confusion when you come to the charts. A general rule for this is that when you come to the charts in the morning or at nighttime, wherever you are in the world, you want to basically know within the first couple of minutes whether there's going to be a setup or not. You want to know where price has to come to. For example, a point of interest, an area of liquidity, a resistance level, a support level, whatever it may be. You want to basically know that if price comes to this area, I am ready to execute a position, or I am ready to monitor price to see if an entry confirmation appears, whatever that may be. So yeah, as a general rule of thumb, you want to basically know within the first couple of minutes whether a setup is going to appear or not. And if it isn't ready just yet, you want to be setting alerts at those areas and then going about your day, waiting for those alerts to trigger. You also want to be including a risk management plan inside this trading plan, which is arguably even more important than the strategy itself. All this has to include is, you know, you can make it very, very simple and just simply include what percentage risk of your account you're going to be risking every single trade. For myself personally, this is 1% of my account balance, so that every single trade I know I am executing with 1% risk. I don't need to think about it. It's a mechanical and simple process that I follow every single time, and that basically takes any of the mental strain and effort that goes into executing my trading plan, you know, without any hesitation, without any errors. Because if you are constantly thinking about how much you should be risking on this particular trade, you know, how big your stop loss should be, what lot size you should use, all of this takes a lot of energy, and that is energy that could be spent on actually executing your trading plan instead. So it's best to come to the charts knowing exactly what risk you should be executing the trades with. So if we actually go over to my trading plan now, and I'll show you guys exactly what I mean. So if we just get up this document right here. So the example strategy itself is, like I said, very simple and very mechanical, tailored to me specifically. But I've just basically written out in a couple of simple steps for example, identify market structure and direction, identify a point of interest. I have 2 types of these as well. And then once price comes into my point of interest, I have an entry model, which I need to see in order to execute the trade. I have a second entry model as well, in case the first one does not play out. I know exactly where I'm targeting, and I also know exactly how much I'm risking. As I said, in my case, this is 1% risk per trade, maximum 1 loss per day. So if I have 1 loss, then I'm not looking to re-enter. I'm not looking for any more trades on that day. And I only make break even when there's some sort of high impact news coming out, so as to avoid slippage. But apart from that, I don't make break even. And I also have a minimum risk to reward that I need to see as well. But this whole section right here, that is simply the risk management plan. So as you can see, it's very simple, 4 short bullet points, making it as concise as possible. So the final thing that I want to say on the trading plan as well is that, you know, it's all very well writing all of this, but if it's not backed by data, then there's literally 0 point, because it might not have an edge in the market. So for myself personally, I use FX Replay, which is a backtesting software. And as you can see, I've got massive amount of data on this particular strategy. I only now trade gold and GBPUSD, but as you can see on gold and GBPUSD alone, I have 2021 to 2023. I have just the 2023 price action. I have monthly reviews at the end of every single month. I've tested it on Mondays. I've tested it when I have liquidity versus no liquidity. I have quarterly reviews. I have 1 to 3 targets. So there's a lot and lot of data on this particular strategy. And that is what gives me the confidence to execute this and to know that it actually does work. So long story short, make sure your strategy is backed by at least 2 years of historic data, so that you know that it actually has an edge in the market. And not only that, if you have some data on the strategy, then you've had practice in actually seeing the strategy in the live market, because I could give you this exact trading plan right now, but the majority of people would not be profitable with it because they don't see the market from the same lens as me, just because, you know, I've practiced seeing this in the market every single time I look for a trade, whereas somebody else may have practice looking for something else. So yeah, make sure to backtest and collect data on the strategy, and then make sure to write out a concise trading plan. And this will massively help you guys out. So the next process that I want to get into is journaling in all of the trades that you actually do take, and also, arguably more importantly as well, any of the missed trades that fit your entry criteria, fit your plan, but that you perhaps missed for whatever reason. It could be that you were out, could be that you got fear of entry and just didn't enter, but all of these sorts of things. So what I wanted to say about this is that any business on earth, you know, especially the profitable ones, track their performance in some way, whether that be accounting, bookkeeping. All of them seem to have KPIs such as, you know, net profit as a percentage of gross profit, average turnover period, all of these sorts of things. Every single business has them, and trading is no different. But in trading, the main metric that we're going to be using is obviously the performance metrics, such as profit and loss. Those are the most important things. And in order to see the profit and loss, we obviously have to journal the trades. Otherwise, we don't have a record of how much profit we made or how many losses we made. So yeah, journaling is how we can do this. You can either use expensive softwares such as Edgewonk, or, you know, I'm not going to name other companies, but you can use expensive softwares definitely. Or you can simply use a Notion template. I will include this template in the description for you guys, but the one that I personally use, we can see we have monthly reviews, quarterly reviews, and then the trade journal itself, where we click on the calendar, we add the trade journal, and it's simply any of the trades that I took that day, plus missed trades. I would do a short technical and psychological review of that trade, include some screenshots and also some lessons learned. So that the psychology also means that this is just a record of how I managed my emotions, whether there were any psychological mistakes, such as entering too late because I got FOMO, any of the things, aligning with your mind and how you think. So I'll leave that template in the description, but that is a very basic template of journaling. It doesn't need to be complicated. Remember that the purpose is simply just to keep a record of all of the trades that you take so that you can tally up your profits and losses, and also to see where you're going wrong and what you're doing right. Another thing that journaling also helps you to do is when you are going on tilt. So if you keep, for example, writing in your trading journal that you executed even though it was not a valid setup, then that is called tilt. It means you're deviating from your trading plan. And journaling is obviously going to, first of all, help you to identify when you are going on tilt, but also a possible reason as to why you are going on tilt. For example, it could be that there's an external factor in your life affecting your psychology, meaning that you want to jump into trades because you need some money to pay for bills or something like that. It could really be anything, but trade journaling will just help you to identify when this is happening and how you can go about correcting it going forward. And the main purpose why we journal the missed trades as well is, I've said down here, to train your eye and your reticular activating system, which is the part in the brain which recognizes patterns and commonalities between the different types of setups that you are taking. It's just basically going to train your eye to see your setup more quickly and efficiently. And I don't really need to go into too much detail about why this is an advantage. If you can see your setup quickly without any thought, well then, you're going to be able to execute more effortlessly and without any errors. It just sort of becomes a subconscious process. And over time, you'll get better and better at doing this, seeing all of your setups playing out, and also as a result giving you more confidence in your trading plan in order to execute it in the live market. So the next one is very similar to journaling, and the template that I just showed you, you can do it in this same template, but it's basically performance reviews / ASR, which stands for advanced self-review. Personally, I do daily, weekly, and monthly reviews. So for the daily reviews, at the end of each and every single trading day, I will go back to the start of that day on TradingView, and I will just basically observe how the price action played out, how price behaved, what levels did it react from, were there any trades that I missed according to my plan. And this is where I will go back to my trading journal any of the missed trades and any trades that I actually took, if I did take any. The weekly reviews are a little bit different. So as for the weekly reviews, I will show you guys an example. I will simply get up this document right here. If we scroll to the bottom, and this is essentially where I will rewind price to the beginning of the week. I do this on Friday evenings. I will journal any of the trades that I took that week, any of the missed ones, and also write down my profit and loss for the week. So for example, last week, I didn't end up taking any actual trades. So obviously that was a 0% gain, but I did have a couple of missed trades. So for example, with the case of GU, we had this trade, which I missed because it happened at market open. The actual strategy itself is not really important here, but the way that I journal these is I will write a quick summary of why I was looking for this trade from a technical standpoint, and then also why I missed the trade or how I managed my emotions as well. For example, this one happened at market open, so I missed it. I did, however, anticipate the buys after the sweep of the daily liquidity that we had. So the analysis was very good. I just missed it because it happened at the wrong time. And then I would do this for every single one of my missed trades, as you can see. And then at the end, I will write out some points, what went well, what could have been better, and any lessons that I learned and things that I want to take forward with me in order to improve my trading. So that's the weekly review. Monthly review, this is just going to be the same as the weekly review, but obviously it will be on a month by month basis. So I'll rewind price to the beginning of that month, do the same thing as I did with the weekly review, and I will also go back onto FX Replay and back test that entire month to see if there were any trades that I missed, and also to review the ones that I took. I only trade GU and gold, so I only do it on these 2 pairs. If you trade more pairs, then obviously you'll have to do it for every single one of those pairs. But yeah, next process is to actually go about preparing your charts the night before. So if you're in the UK, London session starts at around 8 a.m. in the morning, and then obviously New York is around 1 till 3 p.m. But what this means is that we have an advantage because the night before, so for me this would be 5-6 p.m. after New York closes, I will go back onto the charts. I will mark up anything that I'm looking at for the next day. I'll mark on any of my point of interests plus liquidity levels. And what this allows me to do is basically just to react to what price shows in the morning, and it basically prevents me from rushing into setups. I'm prepared the night before. I know exactly what I'm looking at because I've already forecasted my analysis and all of the areas that I'm looking for. So I'm basically just ready, prepared, and this basically just helps me to execute my trades in a less chaotic state of mind. I'm not rushing or, rushing to get into setups. I know exactly what I'm looking for. The one thing I would say about this though is you don't want to do your analysis the night before and then stay married to a particular bias or idea. For example, let's say the night before you're looking for GBP USD buys, but then during Asian session, price just completely melts, breaks some structure to the downside. You don't then want to be staying married to the idea of seeing buys when price has flipped back bearish and the trend has now ended. So it's just the point of this is basically just to have a rough idea of what you're looking for, but not stay completely set on a particular area or bias. We can then react to price in the morning, but we can do this more efficiently because we already know our sort of higher time frame direction and any of the things that we are potentially looking at but not necessarily staying married to in the morning. As I said here, Asia session can change your outlook, so just keep a general idea of setups instead of having like a set in stone bias. I am definitely going to enter here, or I am definitely looking for buys no matter what. Just keep a general idea of where you want to see price come into and any of the setups that you are looking to take. So the fifth and final process that I would implement in order to improve would be actually to have other things to do. So the worst thing that you can do, particularly if trading is your only thing, is to look at the charts all day and actively look for setups because of boredom. So what this means is that you would be sat on the charts and then you're actually like looking for a trade to take rather than letting the trades come to you. And this can be very bad for your trading. Last summer I went from being full-time at uni and having not that much time to spend on charts to having all day to focus on the charts. And during the previous months when I was still at uni, I had For that year, I had made 35% on my personal trading account. And then during that summer, I lost 10% of it. And I would attribute this to just being bored and actively looking for setups, taking bad quality setups just because I wanted something to do. So yeah, this is definitely something that can be detrimental to your trading performance. And I would definitely look to have other things to do. Maybe start making content, start going to the gym. It could be anything, just whatever you like to do. Make sure you're not looking at the charts all day. Maybe also have some set times where you're looking for trades. For myself, it could be London session 8 to 10 in the morning, and then New York session 1 to 3 in the afternoon. This basically just, allows you to have a set in stone routine. Again, this routine can be auspicious to good trading performance and to consistency. And that's obviously going to have a positive impact on your trading. What I find best to do is, if you're, particularly with my style of trading, I'm not a lower time frame trader, so I will wait for price to come into my areas. And then once price is in my area, I'll be monitoring for an entry. But until price actually comes to that area, then there's not really anything to do. So the best thing that I've found, if you trade in a similar way, is to simply set alerts at key levels and areas, and then go and do other things while waiting. Once the alert is triggered, then you can step onto the charts and monitor for an entry. The reason why this is a good thing as well is that, we have limited energy. Every minute you spend on the charts, you are using some sort of energy, because if we go over to the charts now, whenever you're seeing one of these candles play out, you are making a subconscious decision to either stay out of the markets or execute a trade, or you're making a decision to look for a trade or to not look for a trade. But every single minute and second you spend on the charts, you are making some sort of mental decision. And obviously that's using some limited energy. So if you spend less time pointlessly looking at the charts like this, then that is more energy that you have at your disposal when price is in your entry zone and you are actually looking to take a position. And this is going to lead to higher quality execution, higher quality A+ setups. And obviously this is going to indirectly or directly lead to better trading performance overall. So yeah, that's what I want to say about this. Just have other things to do throughout the day. Don't just spend all of the time on the charts looking for setups. Let them come to you, and this will massively help your trading performance. Alright guys, so that concludes today's video. Remember that you don't need to implement all of these 5 things at once. You could start with one and then gradually start to implement all of them, because I believe that even adding one of these things to your trading will definitely improve your results, as I have personally found that. So if you guys ended up enjoying this video and you got some value from it, as always, be sure to like and subscribe for more content like this, which I drop every single Friday. And I will see you guys in next week's video.